Hello, everybody. Adam Bergman here, tax attorney and founder of IRA Financial. On today's video, self-directed IRA MythBusters. Today's video, I'm going to go through a number of self-directed IRA, checkbook control myths, falsehood lies that I've heard over the last 15 or so years that want to correct and set the record straight and let you know exactly what actually the truth is from a legal perspective as a tax lawyer, someone who's practiced tax law since 2001, someone who's been in the retirement space over 15 years, someone who has a master's in tax law. I'm going to give it to you straight. So today's video, I'm going to go through all, I think, the primary myths and lies that I've heard, and some are interesting to talk about, some are ridiculous, but I thought I would share it with all of you because I think you can get something out of it. So just quickly, I'm going to go through just the basics, what a self-directed IRA is, how it works, the history, and then we're going to talk about some of the myths that I'm going to unravel. So IRAs were created in 1974 by ERISA. It's almost 50 years, September 1974. IRAs and self-directed IRAs, the term self-directed IRA, you're not going to actually find in the tax code. There's no distinction between IRAs that invest in traditional publicly traded securities or IRAs that invest in real estate. Okay, the tax code does not distinguish. It just talks about IRAs. So the advantage of using an IRA is if it's a pre-tax IRA, you get a tax deduction for making the contribution. Contribution limitation, $7,000 if you're under 50 years old, $8,000 if you're over 50, 2024. If it's a Roth, same contribution max numbers. In the case of a pre-tax IRA, if you're under 59 and a half and you pull the money out, you pay tax and a 10% penalty. If you're over 59 and a half, you pay tax. Whereas in the case of a Roth IRA, if you're over 59 and a half and the Roth has been open at least 5 years, then everything you pull out of the Roth IRA is tax-free. So from a self-directed IRA context, why would people go self-directed? Why would you want to invest in alternative asset investments versus stocks? So the first is diversification, right? The concept, the idea, you don't want to put all your eggs in one basket. So you don't want to have all your assets invested in stocks. 2, freedom, control, right? Some people just want to have more freedom to invest in different types of assets, whether it's real estate or gold or cryptos or private equity or venture capital or private businesses. They want the freedom to have choices. And the IRS gives us all the choices. Why? There's only 3 things one cannot do with an IRA. First, insurance. You can't buy life insurance. Second, collectibles. You can't buy art. Thirdly, under 4975 is you cannot engage in any transaction involving your IRA that in any way directly or indirectly personally benefits you, your lineal descendants, parents, children, spouse, daughter-in-law, son-in-law, or any entities controlled by such persons. Okay, so you can't buy a house and live in it. You can't take your IRA, buy yourself a car. The IRA investment must 100% exclusively benefit the IRA. Okay, and then another reason why people are flocking to self-directed IRAs is folks want to invest in what they feel comfortable with, right? Warren Buffett, one of his 3 investment tips is invest in what you understand, right? Buy companies you understand. So some people don't understand how the publicly traded stock markets work, right? Whether it's NASDAQ, New York Stock Exchange, S&P 500, spiders, ETFs, mutual funds. Like, I don't get it, but I understand real estate. I know if I buy the house and rent it out, I'm going to get $1,000 a month. And I think that over the next 5 years, that house will double in value, right? I can touch the house. It's physical. It's a hedge against inflation. So when you add all that together, that's why there's millions and millions and millions of Americans that are using their IRA to make alternative asset investments. Okay. So types of self-directed IRA. So there's a self-directed IRA where the IRA will invest and own the asset directly. Title would be in the IRA. So for example, IRA Financial Trust Company for the benefit of John Doe IRA. Second is what's called checkbook control, which I'm going to get through some of the myths involving checkbook control, where the IRA owns an LLC. The LLC is managed by the IRA owner, But the use of the LLC gives the IRA owner what's called checkbook control, the ability to write checks to make the investment, pay expenses, or a wire, Zelle, Venmo, whatever it is. And since an LLC is a flow-through disregarded entity, all the income and gains will flow back to the IRA without tax. And then a third is a concept that I was the first to employ back in 2010, is instead of an LLC using a trust, right, a revocable grantor trust, having the IRA as the grantor and beneficiary of the trust, and then the IRA owner as the trustee, you still get the checkbook control, but you lose the limited liability protection to the same extent as an LLC. You do gain greater privacy. And then there are, depending on the state, some potential state tax ramifications of using a trust over the LLC. But it is still an option that some folks like to use. So let's start with the first trend. Self-directed IRA is a new trend. That's myth number one. That's wrong. Self-directed IRAs, as I mentioned, have been around since 1974. The self-directed IRA industry was born the same year the IRA industry was born. So instead of Fidelity, it's IRA Financial. Our industry, born the same year as the traditional broker dealers. The only difference is the self-directed IRA industry, we don't sell investments. We don't give investment advice. We're not a broker dealer. We are neutral and agnostic to the investment. Our model, our service, our expertise is in the administration, compliance, record keeping, and consulting on the use of an IRA to invest into alternative assets. So we don't get involved with publicly traded stocks, ETFs, mutual funds. We do not compete with the traditional broker dealers, nor do we want to. So we service the growing marketplace of the 65 million plus IRA investors that want to diversify, gain more investment freedom, financial independence, want to invest in hard assets, assets they know and trust, and want to be able to do that in a tax efficient IRA account. It is not true that this is a new trend. Okay. It's gotten more popular in the last 10 years, no doubt. Specifically, the last 5 to 7 years, we've seen an explosion in demand for alternative assets. But when I started this business, I started learning about the industry back in 2008. It was flourishing. It was a very strong industry, great companies involved. So it's not a new industry. It's not a new trend. It's growing because alternative assets have become more mainstream. There's been a democratization of alternative assets. There's great platforms. There's great products that service the IRA marketplace. And for that reason, it's become more popular, but it is not a new trend. So that is myth number one. Myth number two, self-directed IRAs, they're risky, they're scary. Unless you're scared of yourself, that's not true. What is the word self-directed? You, self-direct. So it's the least scary thing to do. I think it's more scary to trust an investment advisor to manage your money. Then you are trusting that person exclusively to give you the investment advice and the duty of care to safeguard your assets and invest them. With a self-directed IRA, you have the control. You're making the decisions. If you screw up, it's on you. No one else to blame. It's on you. Which is anything more American than that? I mean, if I go down, it better be my decision, right? If I invest in company X and it drops 10%, then I can't blame Jane or Joe over there. It's on me, and I can live with that. And if it goes up 10%, then I can pat myself on the shoulder. But at least it's my decision. And a self-directed IRA may not be for everyone, right? If you feel comfortable having your assets managed by someone else, you don't want to deal with alternative assets, you like the stock market, you like mutual funds, ETFs, you want to have all your assets in that category of asset, it's your choice. God bless you. You can do it. We're in America still. You still have freedom. Okay. But for the growing segment of the population that wants diversification, that wants to invest in different types of assets, I don't see it as risky. Why? Because you're in control. You're making the decisions. Now, you may feel that you're not qualified to make those decisions, and that's fair. And that's something you have to do and decide. But in terms of risky, no. People say it's risky. Those are the people that don't make money when you buy real estate or invest in your friend's business. Those are the folks that make money when you buy their assets and their products and use their investment advice and investment advisory services. So I think that is false. Do people lose money in alternative assets? Yeah, right, of course. Do people lose money buying stocks? Yeah, I lost money. I owned a bond, a Silicon Valley Bank bond. Okay, I lost it, right? I didn't get it. Depositors got made whole. My bond wasn't made whole. I lost my money. There's risks everywhere. Anyone that tells you that the asset, the investment is no risk, other than a T-bill or a federal bond or something that's FDIC insured, fine. But anything that's not, there's risk. And I would rather put the risk on my shoulders and at least have the power to decide what I want to invest in, for better or worse. I can live with that versus having my portfolio drop because my investment manager, bet wrong on a industry. So you can lose your money. Is there fraud in the IRA world? Of course. Is it risky? I think self-directed IRAs are less risky than regular IRAs because you make the decisions. You can decide the level of risk, right? If you don't want to invest in private placements, you just want to buy gold, not too risky, right? Yeah, if you want to buy altcoins, sure, that's super risky. You can do that in an IRA, but that is risky. More risky than buying Apple stock? Yeah. Investing in real estate, owning a house that you can see and drive by every day, is that riskier than owning Tesla or Nvidia or Facebook? It's your call. I don't know. It's all about the source of the risk, right? For me, I don't feel that real estate's risky. My neighbor may, and that's fine, right? No one's forcing you to do stocks. No one's forcing you to do alts. That's why the tax code gives you the options. It only tells you 3 things you can't do. So I do not believe that self-directed IRA investments are riskier, okay? Again, there's an SEC investor alert. So there is fraud in the self-directed IRA world. Why? There's $13 trillion of money. Most Americans are richer in their IRA than their personal assets, which makes sense because if you're going to save, you'd rather do it in an IRA because it's more tax efficient. Not only can you get a tax deduction for the contribution, but your money grows without tax, which is known as deferral compounded returns. That's the smart way to save. So yeah, there's more money at risk. There's promoters, there's bad people out there that's going after vulnerable folks. But these bad actors, they'll go after the elderly if they have personal money or IRA money. The fact is a lot of these targets do have money saved because they worked and they have former employer 401ks and IRAs, and they're targeting the cash. So you certainly need to be wary of fraud, but fraud does happen in publicly traded stocks as well. Now, some of these deals, you have to be an accredited investor. So that's another layer of protection that the SEC is layering on self-directed investments. There's certain private placements, certain transactions involving private equity, venture capital, real estate funds, investment funds, where you have to be an accredited investor. And that means someone who has $300,000 2 consecutive years before the investment is done of at least $300,000 in income, or you have $1 million in net worth, excluding your primary resident. So that's another layer of protection to say, hey, if you're doing an alternative asset investment, you have to have a certain category of asset classes. So yeah, there's risk in anything you do. You got to do your research, you got to do your diligence, do your homework. But I personally believe there's less risk in alts because at least with a self-directed IRA, you are in total control of the investment decision, not your investment advisor. Okay. Now let's move to checkbook IRA. This is my favorite one. This is my favorite myth. I've fought with competitors, with advisors, not lawyers. No, lawyers get it, but mostly financial people. The checkbook control self-directed IRA LLC is illegal. Can't do it. I heard this in 2008. I heard this in 2012, 2015, 2020, and even 2024. Okay. They're liars. They're wrong. They want to debate me? Debate me. Okay. Let me ask where you went to law school first. Don't debate me if you just read some rubbish on the internet. Okay. I want your credentials. Why can you tell me it's illegal? I want to see your law degree. You a tax lawyer? Don't tell me, oh, I'm a real estate lawyer or I'm a litigator. No. You got to be a tax lawyer. I want you to understand the tax code and understand tax court cases. Okay. If you disagree with me, I will debate you anywhere. But you're wrong. Swanson case was the first case in 1996 that clearly said an IRA can own a newly established entity and be managed by the IRA owner without triggering a prohibited transaction. Swanson was clear that the entity only becomes disqualified once it's funded. So the prohibited transaction rules will only kick in once it's funded. So don't tell me an IRA can't fund a newly established entity, be managed by the IRA. There's multiple FSA, field service advisory opinions, and there's further cases that specifically address the use of an IRA to own a special purpose entity, including an LLC. On top of that, if you want to get a loan using an IRA to buy real estate with Freddie or Fannie, they make you use an LLC. How about that? In fact, if you file a partnership return, a K1, on the K1, it's going to ask if the partner is an IRA. So if you're saying checkbook control is illegal because an IRA can't be a partner in an LLC, well, Form 1065 gives you the option of electing whether there's an IRA as the owner. So all rubbish. Who's telling you these lies? There are self-directed IRA companies that are lying to you. Why? They want you to pay higher fees with full service. They don't want you to use checkbook control. Why? Because with checkbook control as the manager of the LLC, you can write a check, you can do a wire. You don't need the custodian, meaning they can't charge you transaction fees. IRA Financial, we don't charge transaction fees. We have flat fees. We don't charge asset valuation fees. We don't even charge wire check fees. That's why we're the best. But there are other companies out there, and I'm not going to name names. You can search around for yourself. But they'll say, oh, checkbook control is risky. Risky? Why? I'm in charge. That's not risky. Okay. I need to use you. So it takes a week to issue a check. Cost me $100 to pay my plumber, and it's 7 days too late. No, I need the control. I need the privacy. And most importantly, I want limited liability protection. Shouldn't we all? Right? What is limited liability protection? Protects your assets outside of the LLC. Okay. So if you have other IRA money out there, you want it protected. So LLC's been firmly entrenched in the self-directed IRA world since 1996. I've written 2 books on it. I have tax lawyers. I have IRS agents that are clients. It's been established and it's been codified in tax court cases since 1996. So if you hear people, whether they're financial advisors, RIAs, most financial advisors, RIAs aren't telling you these lies. It's mostly other self-directed IRA companies. And I'm not going to mention names. Okay, but you can Google and you can see who's saying this stuff and you can make your own decisions. But I'm telling you, they're wrong and they're lying to you and they want you to pay more fees because that's their business model. They don't care about you. They claim they're protecting you. But how are they protecting you? It's my IRA. I'm the manager. So what? I need you to protect me from myself? No, it's a lie. They want to charge you more. They want to have more control over your assets. So you need them and you have to pay them more fees. That's the truth. That's why I love checkbook control. Yeah, I don't need to charge you more. I want to give you the power and the freedom to make investments within the law. Now, if there was any risk, I, of course, would not be sitting here doing this video as a tax lawyer saying that you can use an LLC to do this. But this was established before I became a lawyer back in 1996. And it's been subject to many tax court cases and even field service advisory opinions from, not me, the IRS. Okay. So this is a major, major fault. This is my pet peeve. It drives me crazy when I hear people say this. I do sometimes have to talk to potential clients that are in touch with us. They want to open an IRA. And they're like, I read online, this company said that checkbook control is illegal. You can't do it. It's risky. I get audited. So I have to say, okay, you get audited. How does this company know what triggers audits? I'd love to know. I don't know. The IRS tell them. So that's a lie because no one knows what triggers an audit. I've been doing this 15 years. I've never had a checkbook control structure audited. 25,000 clients. Okay. Maybe one will. I don't know. But if they're telling you they know what triggers an audit, they're liars because no one knows what triggers an audit. Number 2, well, it's risky. You got to be so careful you don't write a check to the wrong person. Well, guess what? I'm writing the check. I trust myself, right? So They claim they're trying to protect you from yourself, but they're not the government. They're just trying to make sure that you need them and you need to pay them to get anything done. So don't buy this myth. It's a lie. Okay, and here's more of the same. Another myth, and this is part of the checkbook control lie. Yeah, you could do the LLC, but you have to have someone else as a manager. Oh yeah, why would I do that? That's craziness. Why would I have an IRA own an LLC and then have my neighbor as my manager? That means he controls my money. That means he can steal my money. No one in God's green earth would ever do that. It's negligent. So Swanson was clear, along with Peake and Ellis and FSA in 2001, clearly stating that the IRA can own an LLC and be managed by the IRA owner. Okay, so why would I have a third party control my money? What the hell's the point? Another lie. So they're basically saying, well, yeah, we'll let you do the LLC, but have someone else be the manager. When they know no one's going to accept that, because maybe I would let my spouse, but my spouse is a disqualified person, so she can't be the manager. So maybe my brother or sister can, but do I want my brother and sister that I have to call my sister up and say, hey, sis, I need to pay Joe the plumber $800. He's coming to my rental apartment at 3 a.m. Can you write a check? No, I need to be able to do that. What's the point? So it's another falsity. It's another lie. It's another way to get you to open a full service account and not be straight up with the client. So that's really my pet peeve number 2 is, yeah, you can do the checkbook control. We get it. We know there's tax court case out there. We know there's field service advisory. We understand people are doing this. We get it. But we'd advise that you have someone else manage it. Oh yeah, where? Where is that coming from? Prove to me. Show me a tax court case that says that. Oh, well, it's our thought. Well, I don't need you to tell me your thought. You can't back it up, right? Like if there's legal foundation as a lawyer, I'm going to listen to it. But if someone's opinion, I don't believe it. If it's not God or in the tax code, I'm not buying it. Okay, another myth I hear a lot is, hey, you could do a self-directed IRA, but you can't do it with a Roth. That's not true. You could do a self-directed IRA with an IRA, a Roth, a SEP, simple. You can even do it with a health savings account, a Coverdell. Okay, that means you can't self-direct 529 plans, educational plans, but you could do it with Coverdales, health savings accounts, and obviously SEP, simple, traditional, and Roth. So that's a myth that I've heard in the past. I haven't heard it lately, but I just want to share it. It's not true. The self-directed IRA structure works with any type of IRA, including HSAs and Coverdales. This is an interesting myth too. Self-directed IRAs are not tax efficient. I get this a lot from real estate investors, and to give them some credit, in some cases, they're right. And another example is oil and gas investments, where I agree. If you want to invest in oil and gas partnerships, master limited partnerships, don't use an IRA. Okay, it's not as tax efficient. Why? Because the way the tax code is written, the lobbyists in the oil and gas space, they're able to gain very favorable tax treatment for oil and gas investments, such as high deductions and return of capital. That's not taxable. So using an IRA doesn't really help you as much, because you're going to lose the deductions. You're going to lose the fact that you're already getting a lot of the upfront income as a return of capital, not subject to tax. Real estate. Okay, this is an interesting debate. So the advantage of using an IRA or 401k to buy real estate is obviously, number one, all the income is exempt from tax, right? The rental income. And then when you sell the real estate, it's not subject to taxation. Okay, so that obviously is pretty powerful. Now, in the real estate world, just like oil and gas, the real estate lobbyists have done a great job in getting many, many provisions in the code that are beneficial to real estate investors, i.e. depreciation, right? You buy an asset, even though it goes up in value, you get depreciation deductions. Depreciation deductions are great, especially if you can accelerate them. You're going to get high deductions up front. Deductions create losses, less taxable income. No deductions in IRAs, right? Losses don't really impact IRAs. But if you are investing in real estate, you're probably going to use leverage. In that case, you're going to probably potentially pay UBIT, unrelated business income tax, on a percentage of the income attributable to the leverage. So for example, if you put down $100,000 and you borrow $100,000, you have a 50-50 debt to equity ratio. If it's an IRA and let's say there's $10,000 of net income, 50% of that, or $5,000, could be subject to the UBIT tax. which can go as high as 37% once the return is over 15K. So it's an ugly 4-letter tax word. So doing it with personal funds and not IRA in that context, yeah, you can generate deductions. You will get depreciation. You potentially can get capital gains on the sale of the asset. Yes, there will be depreciation recapture, but it's at a lower rate than ordinary income. Higher than capital gains, but lower than ordinary income. Or you can do a like-kind exchange to defer the tax. So I do agree in some cases, real estate deals, oil and gas deals, actually may be better off using personal funds. Almost in every other case, the IRA makes sense, even especially if you're day trading stocks, day trading cryptos, buying and selling any capital asset, whether it's gold, fix and flips real estate, especially assets you're going to hold less than 12 months where you're going to get short-term capital gains. Being able to zero out that income with an IRA, especially a Roth IRA, is very tax beneficial. Okay, but there are investments like oil and gas and real estate or real estate funds that potentially could be done better and more tax efficiently in an IRA. So this is like a half false, because there are situations where using personal funds makes more sense. And I'll be the first to tell a client that. I mean, thank God we're very successful. It's a volume business, right? Like we don't have 5 clients, 25,000 plus. So I don't need to lie to people, right? Because ultimately they're going to come back and do an IRA and do another deal. So if someone comes and says, hey, I want to do real estate, I'm going to use 90% leverage. I'd say, okay, do you have the money personally? If they're like, yeah, I may say, just do it personally. If they say no, then I'd say, okay, are you self-employed? If they say yes, I'll say, no problem. We're going to set you up with a solo 401k, and you're going to do the real estate deal, and you're going to be exempted from UBIT, because 401ks are exempt from UBIT under Section 514C9 for acquiring real estate. IRAs don't get that exemption. They said, nah, I'm not self-employed. I can't do the solo. It's okay. We can block it. I can set you up with a C Corp blocker, and I'll block it and get you 21% instead of 37%, which you may say, okay, that's doable. I'll live with that. So again, another reason that separates IRA Financial from all the other companies in the space is we're not just going to say yes or no. We're going to be honest with you because we have flat fees. We have a great business with lots of great clients, so we don't need to lie to get the extra client, the extra account. We're also going to find solutions, right? We're going to find ways to maybe eliminate UBIT, maybe minimize it, maybe restructure. Maybe we're going to talk about, hey, it's not so bad in this case because you know what? Your investment's going to get you tax distribution. The tax distribution is going to be able to cover the UBIT tax. And we suggest talking to the manager of the investment and making sure the tax distributions are treated separately and have any involvement or any way will reduce future distributions. So there's ways to really make sure you're getting the tax to pay the UBIT, and it may not hurt your future distribution potential. You can minimize it and maybe even eliminate it. So there's always opportunities, but in most cases, using an IRA is very tax efficient, especially if you're doing lots of deals and you're going to hold the asset less than 12 months, because you're going to basically reduce up to 37% tax to zero on your deferral, right? Compounding returns. Your money grows faster when it's not subject to tax. Rule 72, get a 9% rate of return, your money will double every 8 years. Okay, you can't do that in a taxable account, right? Why did Warren Buffett say compounding return is the 8th wonder of the world? For mathematics, algebra, simple math. That's why. So that's why using an IRA and 401k to make investments generally, in almost all cases, are more tax efficient. Although oil and gas, if UBIT rears its ugly head, like real estate, or if you feel there's going to be enormous amounts of depreciation deductions that you need to maybe offset future personal income, then yeah, listen, I'll be the first to say that using personal money may work out for you, may be more tax efficient. But in most cases, that's not the case. Okay, another interesting myth. You can't joint venture with a self-directed IRA. That's not true. Okay. Listen, if you want to be ultimately super conservative, then yeah, you can treat IRA and personal money like Superman and kryptonite and say, okay, if you use IRA money, you can't put any personal money in the same deal. Now, obviously, if you buy Apple stock, your IRA and you can own personal Apple stock. There's hundreds and millions of shareholders. In a closely held company, I get it. Closely held investment, maybe not. Now, remember, 4975 are the prohibited transaction rules. What does it say? It says you can't do any transaction with an IRA and a disqualified person. And a disqualified person is essentially you, your lineal descendants, your parents, children, spouse, daughter-in-law, son-in-law, and any entities controlled 50% or more by such persons. So yes, if you own 70% of an LLC, your IRA cannot invest. Okay, straight up, can't do it. If your wife, husband owns 70%, 60%, 51%, your IRA cannot invest. But what happens if you own 27% of an entity? Could your IRA invest? In that scenario, possibly, potentially, I'm going to do the legal lawyer jargon and say, listen, facts and circumstances. If you can prove that the IRA investment is being done to 100% exclusively benefit the IRA, then sure, you can do it. You're under 50%. The entity is not disqualified. The IRS can't argue self-dealing, conflict of interest. It's kosher. You can do it. Now, if the facts were different, meaning, let's say, for example, you own 15% of a business, but the business needed money. And if you didn't make this investment, there was no lenders out there, couldn't get the money from anyone else. And if you didn't make this investment, you lose your personal investment, you lose your job. Then if your IRA invests in that sense, then yeah, that's probably a conflict of interest. There's probably a prohibited transaction because you clearly didn't make the IRA investment to exclusively benefit the IRA because it's helping you out personally. And that's why I said facts and circumstances matter. But what about the situation where you have 100K personally and you have 200K in your IRA and the house is 300K and you just don't want to get a loan? Can you set up an LLC and then fund the deal with the personal and IRA money simultaneously? Can you? Well, let's go back to Swanson. Remember I mentioned Swanson v. Commissioner? It was the first case that really talked about prohibited transactions and the fact sequence where the IRA owns a newly established entity. The case is clear that the entity only becomes disqualified once it's funded. So the argument goes, okay, I have a shell company. I go on sunbiz.org, Florida, set up an LLC, call it Sunshine LLC, and I want to do this deal. So that Sunshine LLC is not disqualified at the time, right? It's a shell. There's nothing in it. It's empty. Swanson says it only becomes disqualified once I fund it. So can you then literally on the same day take the 100 personal, 200 in your IRA, it's 300K, fund the LLC. I manage it and then buy the house, right? The belief is, yeah, you can do it because Swanson's only saying once the entity is disqualified, once it's funded, then the prohibited transaction rules kick in. So at that point, once you fund the LLC, you couldn't add any more personal IRA money to it. All profits and losses would have to go pro rata. You couldn't take any fees as manager, right? You would want to treat that transaction, that investment, that entity is closed-ended. Basically lock it up. Say, okay, I'm not adding any more capital contributions. I'm not going to add any more money. I can get Joe or Jane, my friend, to add money, sure. But no more money from a disqualified person, no more money from an IRA. Why? Because Swanson says the entity only becomes disqualified once funded. So I funded it, I'm good, I'm kosher. But if I added more personal IRA money to that sequence, to that investment, based off Swanson, I'd probably trigger the prohibited transactions. So you couldn't do additional contributions. Whereas if your IRA owned 100% of an LLC, I have no issue if you add more money to it because technically you're still going to own 100%. An IRA is technically not a disqualified person, even though some folks believe that to be the case. That's not true at this point. Part of the Build Back Better bill from 2021 that didn't pass, there was a provision in there trying to make the claim clear that an IRA is a disqualified person, but that never became law. So technically, IRAs can transact with IRAs. They're not disqualified people. That actually should have been in myth number 8, but I forgot about that. Myth number 8 is a fun one. Can an IRA invest in a business? So the myth is here, no IRA can invest in any business you own. So this is very, very closely knitted to myth number 7. Why? Because it's all based off 4975, prohibited transaction rules, disqualified entity. if you own less than 50% of the entity, it's technically not disqualified. So if you own 41%, 21, 11%, 1%, and it's a business, it's a restaurant, a bar, a consulting company, a manufacturing company, whatever, sells widgets, and you want to make the IRA investment in that entity because you think it's a good deal, you're going to grow, you're going to get sold to private equity, you're going to go public, whatever it is. Then again, what's the analysis? The analysis is the entity disqualified. Well, okay, the first set of facts to look at, ownership. Does disqualify people own less than 50%? Yeah. Just me, I own 12%. Okay, who else owns the rest? Random people. Okay, good. Is there a self-dealing conflict of interest? Is the IRA making the investment to 100% benefit the IRA? The answer is yes. Good, you can do it. The answer is like, I don't know, I'm scared. Then I always tell people this. Okay, imagine the IRS knocked on your door and said, hey, Adam, we heard you did this deal. How confident and comfortable are you to defend that transaction at that point? To say, well, yeah, my IRA invested, but it's a great deal. It's a startup. It's doing great. I only own 12%. We don't need the money. We got a bunch of money in the bank. There's plenty of other investors. I can go get a SBA loan. I can get a credit line. Like the 50, 100K investment from my IRA, that's all upside. It's not helping me. My salary is the same. Nothing's changing in my business. I think you're good to go. If you're like, well, I'm kind of in big trouble if I don't make this investment, not a good fact. So there's a case called Rollins v. Commissioner from 2004. And Rollins was an accountant. He owned a bunch of companies, all under 50%. The problem is some of these companies needed money pretty badly. So he was an accountant. He took his 401k from his accounting firm and lent the money to the companies, prevailing interest rates. The companies paid back the interest. He got audited. They argued prohibited transaction. He went to tax court and he lost. And his position was like what I'm saying. Hey, I own less than 50%. I'm good. Leave me alone. Get out of here. They said, yes, you're right, Rollins, but we don't feel like you made the IRA investment to exclusively benefit the IRA. You're the taxpayer. The burden of proof is on you. The onus is on you. Prove otherwise. His facts were bad. He didn't. If he could show that he had the money lined up and he could have had 10 other people lend it to the companies, then maybe he's good to go. But he didn't have those facts and he lost. So yes, an IRA can invest in a business, must be less than 50%. It also must be done to 100% benefit the IRA. Here's another one. Can your IRA invest in a business you manage? So let's say you don't even own it, right? You're a director, a manager, president, vice president. Then yeah, because you have no ownership, right? So you're under that 50%. You're a disqualified person, but the entity is not disqualified. The entity is only disqualified if it's owned 50% or more by disqualified people, or if it's 50% or more by disqualified people and another person that you want to transact with is either a 10% or more shareholder or a director or a highly competent employee. So that example is this. I own 80% of a business and my partner owns 20%. Okay. And now I want to lend my partner money to buy a house for himself and his wife. Can I do it? No, because my partner is disqualified to me. Why? Because I own 50% or more of a company and he owns 10% or more. Or let's say I owned 100%, okay, and he was the vice president or CFO or the director. Technically, since I own more than 50% and he's a director, he's disqualified to me. So I can't transact with him, okay? But that's not the scenario I'm talking about here. Here is I own nothing, okay? I don't own 1% of a company, just the CFO, and my IRA wants to invest. Yeah, because again, you don't have that connection. You don't have that 50% to trigger that management requirement. If I owned 51% and I'm the manager, then my IRA couldn't transact and invest. Okay, this is interesting too, because there's some competitors out there that make you open up new IRAs for every investment you do. You don't need to do that. We have some clients that have 15, 20 investments in one IRA. You can do it. Now, are there advantages for opening up separate IRAs? Maybe, right? If you don't have the LLC and you want to bifurcate risk, then yeah, you can potentially set up an IRA for real estate A, an IRA for real estate B, or an IRA for gold. You can do that, but it's not required. Okay, if you're just going to do like 3 hedge fund investments, you don't need to open 3 IRA accounts and pay me 3 times. No, just use one IRA. We have a flat fee, no account valuation fees, no asset management fees, right? No check fees, no wire fees, no transaction fees. So you don't need to waste your money. You could, if you want to, if you just want absolute greater protection, but depending on what you're doing, it may not be necessary. So I wanted to include that because I get this question a lot saying, hey, I'm going to do 4 investments. Should I open up 4 IRAs? I'm like, well, yeah, it's great for me, but like, I don't think you need to do it. So explain to me what you're thinking. And then I find out they're doing like private business investment, very little risk. I'm like, save your money. You don't need it. Okay. This is an important one. Myth number 11. A lot of financial advisors, RIAs say, you know what? Yeah, self-directed IRAs, maybe they're not so risky because, again, you're in total control. You make the decisions. Obviously, you're not going to invest in something that you think is too risky. But you know what? You know what, Joe? You know what, Jane? Every year you got to do these valuations, and it's going to get expensive, and it's very risky, and you shouldn't do the self-directed IRA because you got to get these formal valuations. Wrong, false. Okay. So let me just break this analysis down twofold. If you're under 59 and a half, you don't just give us the number. We don't need anything, nothing on paper. And in fact, if you go to Mexico for a year and we can't find you, we're going to use what you paid for the asset or your previous year's valuation. So don't believe that nonsense. Don't believe you need to hire KPMG or PwC to give you a $15,000 valuation. It's rubbish. It's not true. Now, let's say you're over 59 and a half and you want to do an in-kind distribution of the asset. So you own a piece of real estate and you say, you know what? I want to own this personally. I want to take it out of my IRA. In that case, yeah, we need something on paper that says what it's worth. We don't need a $40,000 valuation from KPMG. It could be Zillow, right? It could be an online source, just an independent source. It could be your tax records. We just need something to kind of staple to your statement and put in our files. That's it. We're not asking you to go hire Goldman Sachs or Merrill Lynch to give you a valuation. Okay, so don't worry. Now, let's say you're 73 and you have to take requirement minimum distributions. You're just going to need to attest to the value, just to basically sign that this is what it's worth. We don't make you, again, use Goldman Sachs or JP Morgan or KPMG or PwC or any large or any accounting firm to independently verify and provide an independent appraisal or valuation of the assets. No, we don't do that. Whoever's telling you that's required is a lie. Ultimately, it's you, right? If the IRS audits you, even if you gave us an appraisal, it's not worth anything. An appraisal could potentially get you out of penalties. But if you get an accountant to say your IRA is worth $1 million and the IRS thinks it's worth $3 million or 800 grand, like the other day they can say, we don't buy your appraisal, go get another one, or we don't believe you. So we're not going to force you to spend all this money to give us an appraisal letter for your IRA when it's ultimately going to be between you and the IRS, right? We're there to help, but they're not going to care that we have some statement attached to your file. They're going to say we agree or we don't agree. Now, for the record, I've never seen an audit where the IRS contested valuations, but if I was the IRS, I would certainly be more focused on valuations than prohibited transactions. Why? Because as long as the money stays in your IRA, especially if it's a pre-tax IRA, if I'm the IRS, I'm getting the money eventually when you hit 73 and beyond. So I want the IRA to stay as high as possible in value. So by going after prohibited transactions, I'm actually hurting myself because I'm prematurely getting the tax revenue today where I could potentially get a lot more down the road. But valuations I care about, because if you're somehow gaming the system and you're discounting your IRA 50%, 70%, now you're hurting me, Uncle Sam. And I'm certainly going to be aware of that and be cautious about that. So I could see from an IRS standpoint why they would care more about valuations. But have I seen an audit in 15 years on valuations? No. But I can tell you what our procedures as a regulated trust company. If you're under 59 and a half, just give us a number. If you go to Mars for the year and you can't find you, we're just going to use your previous year's number. Don't sweat it. If you're taking a distribution of that asset, we need a value. So you can give me an online value, an independent value, something. You don't need Goldman Sachs or KPMG. And again, if you're RMD over 73, got to give us the value so we can determine the RMD amount. Give us the number, certify it, sign it. We don't care. It's your decision ultimately. It's a self-directed account, and ultimately it's going to be your involvement with the IRS. Okay, this is a really interesting one. I get this for some folks, not a lot, because our fees are obviously pretty moderate. Self-directed IRAs are so expensive. It's BS, right? If you don't want to know what's expensive, is paying an RIA 1% to basically pick ETFs and mutual funds, right? Like, or now they're going down to 75 basis points. So you have $1 million with an RIA, they're charging you $7,500 or $10,000 a year to put you in some ETFs and look at your account every quarter. Some of the bigger money managers are like 50 basis points, 60 basis points, but anywhere from 50 basis points to 1% of your assets for just giving you investment advice and picking ETFs. So if you look at our fees, if you look at $150,000, $460, it's 31 basis points, right? 200,000, you can do the math, right? Our fees are super low. They're flat. As your IRA goes up in value, we don't charge you more. We don't have check fees, we don't have wire fees. We don't have transaction fees. So you can have one IRA and 15 transactions. We think it's very cost efficient, way more efficient than using a financial advisor. And it should be, because again, this is a self-directed account. You shouldn't be paying me if your IRA goes up in value more money. That's unfair. Why would you do that? You got to be stupid to do that, right? And there's other companies in my space that get away with it. I don't know how. I mean, I think some of the clients are sleeping or they don't get, but there's a lot of leakage. A lot of value is lost to high fees for no reason. Okay. So you start off at 100K, and again, rule of 72, assuming a 9% rate of return, your money doubles every 8 years. Now you have 200K. Okay. The custodian, the self-directed IRA custodian did nothing. You did all the work. You picked the investment. You manage it. So why should you pay them more money? Because you are smart. Listen, IRAs are going to go up, right, based off compounding returns. So why would you just cumulatively pay more in fees for no reason? You don't have to. And that's our fee model. I think that's what is, to me, one of the most important things of what we do is being fair and reasonable and giving our clients the best service for the best price. So if you are listening or watching this and you somehow pay asset valuation fees, I'm sorry, you don't have to do it. I'm not going to tell you to stay where you are or move, but you have options. Okay, and that's your choice. But just note, and you can do the math, the more fees you pay for no reason, the less you're going to have at retirement, less your family's going to have, less your money you're going to have to enjoy your life for no reason. It's one thing if they're giving you investment advice. If they're saying, hey, buy Tesla over NVIDIA or buy Meta over Google, fine. At least there's some alpha there. But with a self-directed account, you're making the decisions. So you've got to be crazy, like loco, to pay asset valuation fees. And sorry, I don't want to, I don't want to basically degrade anyone or talk down to anyone. It's just, you don't need to do it. You're literally throwing money away for no reason. And it's not just, it's your retirement money. So it's your kids' money, your family's money that you're giving to a rich custodian who's already rich that shouldn't be charging you for that service. So just please pay attention to fees. If you're a client of ours, I'm happy to talk fees too. And I really can show you and feel strongly about our fee model and the fact that we are very, very fair and reasonable. We don't charge asset valuation, wire fees, check fees, transaction fees, even Roth conversion fees. So we include everything, bundle it all up so you can get the best value. Okay, that's it. Here's obviously fees matter. I talked about this. You know how we're different. We're the best for a reason. I got a couple questions here I'll jump to. I hope you guys enjoyed it. I'm going to do a myth buster on solo case as well. I feel like it's a fun topic to, war stories over the years. Okay, HSC seems really good. I'm planning on one-time QHFD from a traditional IRA. I'm wondering if it's worth over contributing to HSA or just paying the 6% fee if the returns are higher. Yeah, I mean, HSAs should be used for its intended purposes to pay health costs. It's a great idea because it grows without tax, so you can use that money and take advantage of compounded returns and also self-directed. So, Pete, it's a great option. Really tax advantageous account. Next question. In an IRA LLC annual report, what should the principal and mailing address for the LLC? The IRA Financial address or my home address? Well, when you set up the LLC, it should be the LLC address, right? If you set up an LLC in Texas, you're going to need to have a local address in Texas for the mailing address. So I would use the LLC address. IRA Financial's address isn't relevant in that setting because the LLC is making the investment, right? Let's say you call your LLC ABC LLC. It owns a house in Texas. The fact that the owner of the LLC is an IRA is irrelevant for purposes of titling because the asset's going to be titled in the name of the LLC. You're going to want to use your Texas address. So good question. Great comment. Thanks, Danny. Love you. You're the best. Appreciate everyone for watching. I hope you enjoyed the video. Thanks so much for spending some time with me today. I hope you really enjoyed it. Hope you learned something from it. If you didn't, well, hopefully it was at least enjoyable and fun. So thanks again. Hope to see everyone again next week. Don't forget to subscribe to our amazing YouTube channel. There's tons of great content on various topics involving self-directed retirement, issues, solo 401ks, alternative assets, current tax events, new tax court cases, anything related to alternative assets and retirement accounts. There's nowhere better online to get content, and it's free. So what are you waiting for? Otherwise, thanks. Have a great day, and speak to everyone again soon. Thanks.